I'm Mark Hebner, President of Index Fund Advisors, and welcome to IFA.TV, where we replace speculation with an education. Today I want to talk about the wide range we're seeing in year-to-date returns among the 15 asset classes that we use in our portfolios, what we call our index portfolios here at IFA. And I just want to summarize these differences by looking at chart 1 on the featured charts section of the IFA.com homepage. If you go to that homepage and you just scroll down the page, you can see we first have rotating banners of a number of videos that you can peruse. We have our 3 simple steps to get started. We have what's new at IFA, which is the latest video and latest article. And then we have a section called Featured Charts. And number 1 there shows you, as a default, the year-to-date returns, but it also provides you returns going all the way back to January 1st of 1928 as we simulate them in our IFA indexes. And if you'd like to see that, you can go to ifaindexes.com to see our time series construction and how we've stitched together various data to provide you over 90 years of monthly returns. So first of all, I want to point out that we have about a 24% difference from the highest return investment this year, which happens to be large companies here in the US, commonly known as the S&P 500. And on the negative side, we have small companies in emerging markets. Those are down year to date as of yesterday, October 10th. They're down 18.29, while the US large company is up 5.71, providing a 24% year-to-date spread between the 2 asset classes. So first of all, this is what diversification is all about. If all your investments move together, you wouldn't have the benefits of smoothing out the ride of holding multiple asset classes. Instead, you'd have a much wilder ride if you concentrate your investments. So this is one of the things we expect is to see varying returns. Now this year, we have a little wider distribution among these asset classes than what we've seen in the past. And so I want to talk about why investors shouldn't try to play the game of moving around their investments based on the current information. And the first thing that you need to understand is that investment returns look like a random walk. So here we have this little device that reminds investors, if you were looking at monthly returns, where a bead here represents a monthly return. And as it bounces around through this series of pegs, every time it hits a peg, it has equal chance to go left or right. And then it lands in a distribution that looks a lot like the bell curve, which looks a lot like 600 months of portfolio 100 monthly returns. And you're then able to see this sort of randomness. Well, we would see similar randomness if we looked at the returns of emerging markets, if we looked at the returns of US large cap, if we looked at small cap, we would see just different averages and different ranges of returns, otherwise known as the standard deviation of the distribution. So, but what I want to really focus on is the inability of investors to forecast what's going to happen from one period to the next. And so I'm going to start with what's often called the periodic table of asset class returns, where we've taken several asset classes here, 2, 4, 6, 8, 9 asset classes, and we've gone back 20 years, so back to 1998, and we've ranked them from the highest return to the lowest return. So in 1998, the large companies here in the US had a return of 29%, while the real estate investments were down 15%. Well, if we were to isolate one of those, let's say U.S. large company, you can see that it went from being the #1 performing asset class to the last of the performing asset classes a few years later in 2002. But it also stayed down below here from 2000 to 2006, either the last or second to the last among these 9 different asset classes. Again, diversification right at play. Now let's say these emerging markets that we were just talking about, having this negative 18% return for the small cap anyway. If we look at a blend of emerging markets, you can see the wild ride from year to year relative to these other asset classes with very extreme results in terms of returns. In 1999, for example, emerging markets were up 72%, while the second highest asset class was actually U.S. small caps at only 25%. But we look at last year in emerging markets, 2017, and we see they were up 37%. So now the year-to-date return of -18 doesn't look so bad compared to the +37 and the year before +12, but then you go back and it was -16. So anyway, the point here is that there is a massive resorting of asset class returns from year to year as we go back over the last 20 years. Now, if we were to take this and resort them again by the investments that had the highest 20-year average return or annualized return, now we can see the winner for this particular 20-year period. By the way, 20 years is still insufficient when looking and comparing investments. You need probably closer to 40 years worth of data. But what we see in this last 20 years is consistent with our investment philosophy anyway, and with the Nobel Prize winning research of Eugene Fama that he did along with Kenneth French, where they ended up saying that companies that are small in value should have the highest returns over long periods of time. So what do we see in this 20-year period? U.S. small value was the #1 asset class of these 9, then small cap, then large value, then real estate, international small value, and the last one, of course, is 1-year fixed income, which is the safest among investments. So that's a little lesson in the rotation of the style or the asset class of investments. I'd next like to touch on what's sometimes people want to speculate on a country return, a geographic area. Maybe they like U.S., for example, or maybe even something as obscure as going to Brazil or wanting to invest in France or Germany at a particular time. So we can do the same type of ranking by looking at country returns, and we can do this under developed markets or emerging markets. We're going to start with the developed markets. And here you can see going back, this is only 15 years, but going back to 2003, we can see that that year, Sweden would have been your best investment, up 61%. And let's see if we can isolate Sweden to see how it did. Then in other years, then you can see it -1, then it was +60, then -18, +19, -10, -2, and at the end, +18. A very wild ride for the asset class returns of that particular country. And if we see Germany, we can see the wild range for that. France, the same thing. Even the US, relative to these other asset classes, is clearly a rotation from one country to the next. And again, why you want to diversify globally. Now let's look at emerging markets, where you can see quite a wide range of returns here. You can see Brazil, for example, having a return of 103% back in 2003, then a -58 back in 2008, around these two really high returns of 75 and 121, basically all over the map. and obviously very risky for investors to bet on what might be the best time to invest in that country. China, lots of talk about China today, and for quite a while actually. We can see in 2003, it was up 81% against that Brazil return of 103, and lots of volatility of the relative position of China relative to these other countries. Same thing for Russia, all over the map. So the lessons are here that you should avoid trying to select any particular country or style of investment over any particular period, quarterly, annually, and basically speculate on which one is going to be the next winner. All right, one other chart I want to talk about relative to people selecting various types of investments, and that is, by the way, the ETF makes this a little easier today. You can probably find an ETF on every one of these little boxes that I'm showing you, and so many investors have moved away from speculating on individual stocks to speculating on one of these styles, countries, or what we call industrial sectors. And I think, like I said, pretty much every one of these you could buy an index fund or an ETF to speculate on that particular area. So let's look here now. Let's say technology. Technology is something people obviously want to speculate on, and we can see here 98, 99. Remember those good days? Good old days of technology returns at 63 and 83. Well, that ended badly. We see here that in 2000 it was minus 37, then minus 25, then minus 38. I think if you add those up, they almost wipe them out. But then we get a plus 49. So you see here amazing volatility from one year to the next, which obviously makes it very difficult. Manufacturing is on the rise again, or has risen. That's a better way to say it. Let me just talk about that point for a minute. We can only talk about market returns in past tense. The reason that is the future is basically a random walk. Beads representing monthly returns bounce all around like crazy. And so you can't say the market is going in any particular direction. It's going down, going up. I hear them on CNBC. Just yesterday I heard somebody talking about some sector, or I think it was actually about value growth, going in any particular direction. We can only discuss what has happened in the past. People can forecast all day long, but that's just a forecast. And I'm going to end up talking about forecasts here in just a minute. Anyway, if we look at manufacturing, you can also see here quite a wild range of returns from one period to the next. Healthcare, same thing. Financials, we hear about all these sectors that investors want to bet on based on some forecast from some market guru. Speaking of which, let's take a look at that, because we hear about this constantly. We get calls from clients, or when we're talking to prospective clients about, oh man, I don't want to do this. I heard a market guru, they don't use that term. We heard somebody on CNBC or Fox Business talking about what's going to happen in the future. And I like to ask those investors, do you have a record of all of their forecasts or a lot of their forecasts, so you can judge their accuracy of their previous forecasts? Before you go bet your hard-earned money based on what they're telling you today, it would be good to know how accurate they have been in the past. So there's a website called CXO Advisory, which you see here in our footnotes. And that individual has been collecting forecasts of many so-called market gurus, and they're all listed here. So Louis Navillaire has made 152 forecasts, and he was about 60% accurate. He's number 2 on our list after Ken Fisher at 66% accurate. Now, before you go check Ken Fisher's website to see what he might be saying, you might want to read this paper by William Sharp, who whose title was The Likely Gains from Market Timing. And Sharpe wanted to determine how accurate those forecasts need to be for the investments based on those forecasts to do better than just a buy and hold investment at some appropriate level of risk or comparable level of risk. And so what he determined is those forecasts need to be about 74% accurate before they're going to lead to a investment return that does better than whatever benchmark Sharpe was thinking about using. And what you see here is out of 28 gurus, all of which had more than 100 forecasts that were analyzed by the CXO advisory group, none of them met Bill Sharpe's criteria of 74% accuracy. And in short, that's why you should give up and not waste your time or your money listening to these forecasts and making bets based on them. So I hope that information was very helpful to you and will get you to hold back from trying to speculate in securities markets around the world. And I look forward to talking to you next time you tune in to IFA.tv.